Canadian stocks at a new record high today. And here's an archetypal Canadian company, Canadian Tire. That company posting better than expected revenue, sales driven by strong demand during the holidays. We're joined by Dan Rohinton, portfolio manager at IA Global Asset Management. Dan, thanks very much indeed for joining us. So the company strength across the board, it seems, all of its major chains.
Yeah, and we can say it's a little bit stronger at Mark's Work Warehouse, where you get your steel-toed boots, and also more so for Sports Check than it is for the core Canadian Tire stores itself, which was a beat versus expectations, but far less so compared to the other banners that they do have. And I think the other thing, Andy, was that losses and write-offs on the credit card, the Canadian Tire financial services business, was broadly speaking okay as well. So I think it's just all those factors together, and let's not forget that we're talking about a company that's trading at 12 times earnings before the move this morning. So the valuation was more constructive for these types of pretty strong results overall. So it's bringing all those things together that led to the price performance we see today.
I guess bitter winter weather is good for Canadian Tire. It's got us scrambling for boots and stuff like that.
Yeah, it's think of it as general merchandise, right? With an auto parts section and then other banners. So having that type of cyclical dynamic, like a really cold winter, definitely does play a role. But it is worth saying that over time, and I know we're going to talk about Walmart in a little bit, but the best way to think about Canadian Tire is it's that general merchandise player that is seeing some pressure at the margin from more Walmarts, more Costco's opening up across Canada. So there is a competitor that does have scale purchasing power, along with Amazon, which maybe gets too much credit for the Canadian e-commerce penetration it has. Not that it hasn't been successful, but the real story of Canadian retail is definitely Walmart and Costco continuing to expand, and then Amazon following them as well.
What would you be a buyer of Canadian Tire? Maybe you'll put up a 10-year chart for Canadian Tire. Would you be a buyer of the stock with new money right now, Dan?
Yeah, I think it's a tough one, Andy, because I'd say in the context of gold prices and gold equities that have been really robust, financial services that have been really robust, I'd be okay with nibbling away. But I think it's important to just take a step back and say in a closed pond like that Canada is, I would say, yes, it might be worth the time. But looking out globally, I think there's more interesting opportunities than averaging into Canadian Tire, including in retail.
Okay, let's swing to Walmart. The company's guidance cautious. Investors weren't thrilled.
Yeah, the best way to think about Walmart is it's several factors at once. The first one is the e-commerce strategy and basically the copying what Amazon has already proven out to be successful. So basically a last mile retail strategy, adding on advertising as a profit driver. We used to call that, or Canadian Tire would call that trade spend, where you basically, the old saying was you basically pay more to be eye level with the consumer as they're walking down the aisle. That's true in the digital world as well. It just shows up through the advertising dollars. So strong advertising business, decent retail sales, and they continue to basically see what's I think is the most interesting story out of Walmart's quarter is they're seeing market share growth amongst greater than 100,000 income consumers. So they're actually benefiting from trade down as consumers in a higher inflation environment are searching for value, and they're finding it through Walmart. I think I will say one thing, Andy, maybe just take to end this long ramble of mine, is at 45 times earnings for mid-single digit revenue growth, inclusive of everything I just said, and EPS growth that's slightly over double digits, it's a pretty rich multiple. So I definitely think that Walmart has benefited significantly from the rotation that we've seen under the hood in the U.S. stock market to start the year, where technology has seen tons of pressure and investors have been hiding in companies where you can't get disrupted by AI, and Walmart has been anointed as one of the primary winners there. So at 45 times earnings, I am exceptionally cautious about where Walmart can go from here.
It's interesting. I mean, the stock is trading near record highs, and it is up today as well. It got to a record last week. So certainly investors like what they're doing in e-commerce, etc.
Exactly. And it's a good, safe place. It's a safe harbor to hide in until there's more certainty around software companies and big cloud computing companies. So there's only a few places like Walmart and Costco that you can go to put real dollars to work. And that is what large pools of capital have been doing to start the year.
It's interesting. They are, for such a huge company, they're an elephant that can dance. They now offer pre-owned Prada bags and also Fender guitars. I think that's in their online channel. So they are willing to adapt.
They're taking the everything store model that Amazon had and cultivated and grew to the scale that it did today. And then they effectively played that forward and are copying Amazon. So right now in revenue, Amazon is a little bit bigger, but if you take out cloud computing, Walmart is still the big dog in the room. But that race is narrowing. So think of the US retail and general merchandise retail market across many parts of the world, but especially in Canada and the United States, as Amazon is the leader in e-commerce, Walmart as the follower, and Costco as the primary on the brick and mortar side. So it is in North America a three-player race, and all these three companies are taking market share from smaller firms, from handbags to grocery and everything in between.
So that's still that great evisceration of smaller retailers going on.
Yep. And there's one interesting story for Walmart's e-commerce success. Things really do come for a full circle in the market. So Amazon put out of business a company called, I believe, Pampers.com back in the 2000 era. The CEO of that company and the founder of Pampers.com actually started Jet.com, which was the e-commerce brand that Walmart bought. And that's what led to Walmart becoming successful in e-commerce way back ago, almost a decade ago now. So we're seeing, ironically, the same players really cultivating and developing the same market, which is e-commerce growth across the world.
You mentioned that Canadian Tire wouldn't be your first choice in retail. Are there any other more global retail names that have caught your attention lately, Dan?
Well, what's interesting, Andy? I would say there were more to start the year, but I think where I'm more interested in technology today. I think the disruption fears have been way overdone, and some of call it the Magnificent Seven stocks that I believe are a little too unjustified in their valuation. But to directly hit your question, where we are doing more work on the retail side is actually looking into those companies that are potentially going to benefit from trade down even more so. So never say never on the US dollar stores. If they can get their supply chains in order, they should also be the trickle down beneficiaries and see the same things that Walmart is seeing as well. So I'd be a little bit cautious on the middle brands, if you will, but I think the trade down beneficiaries, that might still be the place to be. But we're a little early in that research journey, so I don't want to speak too conclusively on that, but that is where we're leaning.
Dan, we better jump. Thank you very much indeed.
Thank you.
Dan Rohinton, Portfolio Manager at IA Global Asset Management.